Hello and welcome to Economic Lifelines Nigeria. In today's episode, we're looking at the role Nigeria's central bank is playing in boosting the nation's economic development through its special intervention funds. Nigeria's central bank has 5 key functions: to maintain external reserves of the country, promote monetary stability, provide a sound financial environment, act as a banker of last resort, and provide financial advice to the federal government.
CBN's role is to stimulate growth in the economy. It may not be through direct intervention. They can use interest rates to stimulate growth or to stifle growth, depending on what role they are playing. So I think anywhere in the world, central banks play that role of stimulating economic development through the use of those monetary policy levers.
Nigeria is a developing country, and therefore, when you consider the very important and pivotal role of finance, capital formation, and access to credit in boosting economic enterprise and activity, you can understand then why the central bank would have a prominent role in economic development. The Central Bank Act of 2007 requires the central bank to report to the National Assembly every 6 months, including on issues of the economy of the country. We have a strategic vision as an institution. Between now and 2015, our vision is by 2015 to become the model central bank around the world, to be the model central bank promoting price, monetary stability, financial stability, and sustainable development. So it's also part of our vision to play an active role in economic development. You will see a large role, but it's not larger than our core mandate of monetary or price stability or financial stability.
The involvement of a nation's central bank in economic development is not a new phenomenon, particularly in developing countries. The People's Bank of China acts as a guarantor for state-funded initiatives managed through various financial institutions. And like the CBN, the PBC is active in promoting financial inclusion with several programs designed to bring financial services to the unbanked. In the US, the Federal Reserve has a dual mandate to create maximum employment and ensure stable prices while moderating long-term interest rates. Over the years, as America's economy has grown and stabilized, the duties of the Fed have expanded, and today these include supervising and regulating banking institutions, maintaining the stability of the financial system, and providing financial services to depository institutions, much like Nigeria's central bank.
The Central Bank Act of 2007 gives the central bank 5 mandates. One is to maintain monetary and price stability. Another one is to issue the legal tender currency. A third one is to manage the foreign reserves that underpin the value of the legal tender currency. A fourth mandate is to promote financial stability. And the fifth mandate is to be a banker and economic advisor to the government of Nigeria.
Traditionally, central banks all over the world have supported economic growth. In advanced countries, now they have an efficient capital market. Their financial markets are deeper. So intermediation is easier, and banks can lend. Private sector is stronger, and then you have, resource allocation is more efficient in those places. In developing economies, we don't have deep financial markets. We have sectors that are of priority to the government, and the banks will not necessarily lend to. You have to do things to go the extra mile in sort of encouraging them and redirecting credits into these areas.
When we had the economic meltdown, you will see the Fed in America also play roles, intervening roles, just the same way the central bank did here. But to the extent that we're in a developing environment, it is quite instructive, and it's nice and very effective when the central bank intervenes in enterprise. That is very, very key. In a stable environment, okay, the market probably can take care of itself all the time, and in a number of the things they are stable. But when it is developing, government has, especially in Nigeria, where government controls significant amount of the national resource, it's able to better intervene in an altruistic manner rather than leaving it to the market to just handle.
Central banks have played a key role as part of emergency action to combat various financial crises in many countries, most notably during the global credit crunch which rocked markets in 2007 and the large-scale increase in government debt which followed. Central banks across the world adopted varying responses to the global financial crisis, which took a severe toll on a wide range of industries. Now, in Nigeria, the central bank set up special intervention funds to help stimulate the growth of key sectors that needed help. Nigeria's central bank rolled out programs to drive the recovery of several sectors. The Power and Aviation Fund is a 300 billion naira intervention aimed at reviving these sectors. There is also a 200 million naira Small and Medium Enterprise Guarantee Scheme, a fund developed with the aim of providing for the wholesale funding requirements of the microfinance banks and institutions. About 60% of this fund will be accessed by women, therefore addressing their specific business needs.
In terms of our intervention in the area of power and aviation and small and medium enterprises, as Nigeria's economy has grown and become more sophisticated, you see that we are being held back fundamentally by very weak power production capacity. You will see, of course, also that the airlines at some point had a very major crisis. They were exposed as of 2010 to banks to the tune of about 250 billion naira, and about 35% of those loans were going bad, were non-performing loans. And so given a number of a number of crashes, airline crashes and so on, the industry was in a bit of a crisis. I should also say that a number of the interventions that the central bank made in 2010, these intervention funds in power sector especially, and the SME refinancing fund, restructuring and refinancing fund, were part of what we call quantitative easing. At a time that it was necessary to inject more money into the economy. In some countries, the advanced countries, they do this by, creating money and buying bonds. And so, but in this country, being a developing country, we felt that we would inject money into the economy, not in such a direct manner, but through the real economy, through agriculture, through power, through aviation, through small and medium enterprises. So these are the reasons why we have done taking these actions.
The central bank's intervention in the agriculture sector includes the Nigerian incentive-based risk-sharing agriculture lending scheme, a non-banking agriculture financial services corporation introduced in 2012 to attend to the fast-growing needs of agribusiness in Nigeria.
As part of the role the central bank plays in the development space, the central bank has played an active interventionist role in the area of agriculture. Agriculture is 40% of Nigeria's GDP, provides about 60% of employment in this country, and therefore it's a very fundamentally strategic sector. The central bank has in the past played a number of interventionist roles to make access to agricultural credit for farmers cheaper than market forces would otherwise have it.
The Central Bank of Nigeria, working together with my ministry, developed a facility to share risk of lending by banks to agriculture. That facility is called NISAL. That facility is $350 million US, and it is going to leverage $3.5 billion US from the balance sheet of our banks into agriculture. That's a financial revolution that is backing the agricultural revolution that we are having.
200 billion naira was approved by the central bank for the restructuring and refinancing facility scheme, aimed at fast-tracking the development of Nigeria's manufacturing sector. To date, 518 companies across 6 geopolitical zones have received from these funds.
The Power and Aviation Fund, which is a 300 billion naira fund, under that fund, eligible companies that are involved in the power sector value chain or aviation companies or aviation value chain can access credit from the banks for about 7% interest rate, which is very low relative to what prevails in the ordinary course of banking business. And they have about 15 years to repay this money, because the fundamental problem or the fundamental challenge of finance as a trigger for economic development in Nigeria is that you don't have long-term money in our economy. You don't have 20-year tenure loans, 15-year tenure loans, and of course the interest rates tend to be quite high for a number of other reasons, including monetary policy reasons, the need to fight inflation with tightened money supply and high costs of credit. Then you have the Commercial Agricultural Credit Scheme, CACS, which is a 200 billion naira fund that was established in 2009. By the way, a lot of these funds, we put them out through the Bank of Industry, using them as the managing agent. It's not the central bank directly that disburses, and we just pay them some sort of management fee, and they handle all that so that we can get on with what many people consider to be our core mandate of managing financial stability and managing price and monetary stability. So the CACS fund is a 200 billion fund, also established in 2009 to finance large-scale farming and industrial agriculture. And I can tell you, and then you have 200 billion naira. Now, these schemes have had quite significant impact. They've created, at least as far as I know, not less than 50,000 jobs in terms of supporting industries that were dying, because they didn't have access to credit, or because the interest rates on the loans they owed the banks were too high and they couldn't pay it, and because of that their factories folded up. But with this kind of access to subsidized funds, these industries were able to come back to life and become productive, and turnover has increased quite significantly, jobs have been created, and so it's had quite a positive impact.
More importantly, at the time when we intervened through the BOI, and then some of the ones we did directly from Central Bank, some of these sectors were heavily indebted to the banking sector. Like you have some of the SMEs, for instance, had very large unperforming loans, and things were like sort of grinding to a halt, which we wanted to stop. So the intervention had ensured that their shops remained open. So on the whole, the economy had benefited from it. We had saved people's jobs, we have created new ones, and that intervention had also done a lot in terms of guarantee to ensure that credit flows from banks to the sectors that are very important in the economy.
The magnitude of lending that has happened has increased about 500 billion. Just the Power and Airline Intervention Fund and the small and medium enterprises, about 500 billion. So the quantum of, in terms of the quantum of loans, that has been substantial. But they are not just loans, these are long tenured loans. Typically lending for longer tenors are not available in the market. If you go to a bank now, it's very difficult for a bank to lend beyond 1 or 2 years because of the nature of their liabilities. But now, with this, what we have done is to put in over $500 billion naira through the bank's balance sheets that are cheap lending, and there are also longer tenor. The small and medium enterprises scheme, the last report that I've seen shows that the quantum of jobs from the enterprises that we focused on being employment, that is jobs created, has increased from about 65 billion to, 65,000 to about over 75,000. So in other words, over 12,000 jobs have been additional jobs have been created through this particularly one intervention. Recently, there was an event where some of the companies have come forward and have demonstrated that new jobs have been created, but more importantly, some of them have even been able to innovate to go into new areas that they are not able to go to because they didn't have access to long-term financing. So quantum of loan has increased. These are cheap loans. These are typically lower interest loans, and jobs have been created.
After the break, we continue our analysis of the significant role the Nigerian Central Bank is playing in stabilizing the economy post-2000.